There's something no one's telling you. The economy is flashing two important warning signs for an imminent recession, and it kind of reminded me of something Jim Rickards said in 2023 that I just had to show you. Those signs are an inadvertent yield curve combined with a rapid fall in interest rates, which is exactly what I need to explore. This is not financial advice, but subscribe to the channel and watch what he said last year that sounds more true than ever.
The bond market is telling a completely different story, by the way, and this is a little more esoteric, but if you look at yield curves, look at the Treasury yield curve, Euro-dollar futures yield curve, German Bunds yield curve, and then, there's a million yield curves. Pick your maturity, but even you can look at the spread between 3-month Treasury bill rates and the expected 3-month Treasury bill rate 18 months forward. That's a little esoteric, but you can call that up. They're all inverted. Now, inversions happen, just meaning the longer term rate is lower than the short term rate. Now, this is in the Treasury yield curve. They're inverted from 1 month to 20 years. It's not like, people talk 2s and 5s and 5s and 10s. And 1 month, a 1 month bill is yielding more than a 20-year note. Okay, that's inverted across the entire yield curve.
And let me tell you why that is in a bird's eye view of the economy. The market for bond securities is usually considered a much safer investment for people looking to park their money because it has the government as the guarantor. Think of it like a financial shelter in times when investors sense an impending crisis, they run toward that shelter, eventually crowding it. And what are they putting their money into? They're putting it in bonds with long-term maturity, usually several years in length, which in the investor's mind is enough time for the financial storm to pass. But would it make sense that bonds with short-term maturity would have a lower interest yield than long-term bonds? Well, the longer you lend your money to the government through the bond, the more interest you should receive. But here's where it gets interesting. Investor behavior crowds the long-term bond market, and that increased demand lowers the interest rate that is paid on it. Over time, this can make long-term bonds less lucrative than short-term bonds, which sounds paradoxical, and that's exactly what is happening right now. Jim Rickards is one of the many economists that believe it's a reliable predictor of a recession.
Bunds have never been inverted. They are now. Even the inversions that have happened in the past, which are rare, have not been as steeply inverted as they are now. We're seeing something globally we've never seen before. And it is the best single indicator of a recession. The last time we saw anything like this was in 2007, just ahead of the 2008 financial catastrophe. So the stock market's saying it's all good, Goldilocks, soft landing, Fed's going to get the memo, they're going to cut rates, the pivot, and buy stocks. The bond market is saying, no, this is bad and it's going to get worse. And it's actually too late for the Fed to do anything about it. See, when these inversions start, sometimes they're a year forward, like, hey, look at the Euro-dollar futures yield curve a year from now, man, that thing is inverted. But what happens is, as you get closer to the actual thing you're worried about, the inversion gets nearer and nearer. Now it is literally a month away or less. So that's like a big red siren, flashing light, whatever you want to call it.
That makes sense because investor dumping their money into the financial shelter of long-term bonds means they're expected turbulence in the short term, and that sentiment has almost always predicted a time of economic recession. Look at this chart where every time the yellow line on the graph falls below zero, it denotes the inadvertent yield curve. The gray bars on the timeline are times of economic recession. Look at how every period of an inverted yield curve is followed by a recession, with the most significant one being in 2008, and then another one after the pandemic. Here's a snapshot of the US yield curve from June, and you can see how strange this graph looks. Starts off at a high yield of 5.47 on 1-month Treasury bills, and then slopes down to just 4.2 to 10-year bonds. Remember, the investor's not going to come out and say it. They're only going to put their money where it makes the most financial sense. For the rest of us on the outside, we need to study their moves and come to a conclusion about what they are anticipating. But maybe that's just part of the story, because there's something else you need to add to complete this picture, and that's because the Fed has been introducing some turbulence in the credit market as well by abruptly raising and then lowering the interest rate.
To say that there could be a rate cut, it won't be in April, but rate cut in August, maybe. I wouldn't rule that out, but for a really bad reason. In other words, if the Fed cuts rates, which they may, the pivot may be real, it's not because they engineered a soft landing and Goldilocks and everything. Oh, that's just right. It's because they screwed up as usual, as they've been doing since 1913. They over tightened. They didn't look at the forward indicators I described, and they found out too late. And then they have to slam on the brakes or take the foot off the brake, if you will, in terms of rate hikes.
Now that's even more interesting when you look at the events that happened last week. A lot of economists were surprised when the Federal Reserve came out and announced a lowering of the interest rates by 0.5%. Which is a rather large drop from a high 5.5%, and that combined with an inverted yield curve could be a sign that the Federal Reserve is trying to land the interest rates, thinking deflation has slowed down. But experts were long calling for a softer landing, so panic and hysteria didn't set in about an impending recession, eventually becoming a self-fulfilling prophecy. Look at this graph of the interest rates, and the last 15 years show a bumpy ride for the economy, almost like a plane that's taking off or landing too hard. And in the last 2 decades, every time a sharp rise in interest rates is followed by a steep decline, it's followed by a period of recession, as shown by those gray bars. Jim Rickards certainly seems to think that we're heading for another one.
Do you see, given that this recession could be worse than most are expecting right now, there being wide-scale layoffs of the sort we've seen in some of the bad previous recessions like '08, like '01?
The answer is yes. First of all, we're seeing it already. I don't match the company to the exact number, but layoffs on order of magnitude 10,000 to 20,000 terminated employees at Google, Amazon, Facebook, and other tech names. It affects other sectors as well, but tech in particular has engaged in a massive series of layoffs. And so people go, well, wait a second, how come that hasn't shown up in the unemployment numbers? Because the unemployment rate is it's around 3.5, 3.6 on the exact number. It's right in that neighborhood, 3.5, 3.6. We haven't seen that level of unemployment, that low, that is, since the 1960s. This isn't like, a good year or a good day. This is the lowest since the 1960s.
One thing should become clear at this point, which is that we've not seen a scenario like this in a long time, and we may be unprepared and inexperienced at how to deal with it. It's pretty interesting how Jim Rickards saw this coming years ago. But being able to see it coming doesn't mean that a potential recession or economic uncertainty is not going to be damaging. However, let me know in the comments what you think could happen, because that is what is going to decide what moves are right in your own financial lives.